Today, the credit monster which is strangling Australia. Hello again, it's Martin North from Digital Finance Analytics, one that is posts covering finance and property news. Well, as foreshadowed, housing has become a major battleground for the parties as record prices, an acute shortage of rental properties and high interest rates combine to significantly reduce affordability. We know that on an international basis, household debt to income ratios in Australia are significantly higher than even New Zealand and Canada. Both have severe housing crises there. Well done, Australia. It's a direct result of 30 years of bad policy and overleverage. And weirdly, even now, according to IFM data, the surge in average loan sizes is behind the significant growth in Australian home prices. Now, the data shows that when you compare affordability to average prices, things are way off kilter, with debt-to-income ratios off the scale, especially for new borrowers. Some are now paying more than half their income to service a mortgage or rent. High tax takes, high interest rates, and high prices are simply not being offset by any rise in real incomes, even as inflation is still holding cost of living higher, and even if the rate of price growth is slowing. Today, I want to look at the latest data on new loans from the ABS in a release that has now gone from being monthly to quarterly. So data released this week covers the October to December quarter of 2024. Talk about lagged data. The RBA gross debt levels for January, by the way, reported a significant uplift, especially for investor loans. As I discussed in a recent post, is the RBA really all in for a rate cut in February? On the way to this analysis, though, we need to pause on the Treasurer's recent announcement that it will soon become easier for Australians with student loan debts to get a mortgage, after Treasurer Jim Chalmers instructed the prudential regulator to relax how HECS was treated when banks conduct mortgage serviceability tests. Up to now, under responsible lending rules, banks have been required to take a prospective homeowner's student loan debt into account when determining how much they can borrow to buy a home, treating HECS the same way as credit card debt or personal loans. But Dr. Chalmers announced that banks can now choose to exclude HECS debt repayments from mortgage serviceability tests when they expect the borrower to pay off the debt in, quote, the near term. This follows the Treasurer writing to the Australian Prudential Regulatory Authority and the Australian Securities Investment Commission earlier in the month. APRA, it appears, will soon start consultations on how to implement this change. People with a help debt should be treated fairly when they want to buy a house, and we're working with the regulators to make sure they are, he said. These are common sense clarifications that will help more Australians into a home. APRA's mortgage serviceability test assesses whether a prospective borrower would be able to afford loan repayments if the RBA raised the cash rate by 3 percentage points above its current level of 4.35%. Of course, there's been a lot of pressure on APRA to reduce that buffer. Now, APRA will also exclude the value of student debt from the reported definition of debt to income, which also affects a person's eligibility for a home loan. The rationale is really a bit flaky on the basis that a person has no obligation to repay HECS unless they earn at least $54,435. If a person loses their job, their HECS repayments are suspended. But of course, these repayments do get deducted from income, so real disposable income is actually reduced. Currently, a person earning $150,000 a year pays $14,250 per year in HECS. Under current mortgage serviceability standards, their home loan borrowing capacity is lowered by around $90,000 to $131,280. And compare the market analysis shows a tertiary educated single professional earning $125,000 will be able to borrow an extra $95,000 based on the announced changes, and the extra borrowing power for someone earning $100,000 would be more than $56,000, whereas a person earning $75,000 can borrow an additional $26,800. Separately, by the way, Dr. Chalmers has asked APRA to clarify that property developers do not need to have pre-sold 100% of units in development before being eligible for bank finance. Some banks have interpreted advice from APRA back in 2017 as requiring 100% pre-sales, although this was never the intention. By unlocking more finance from the banks, we'll see more housing projects get off the ground more quickly, Chalmers said. So all of this is driving mortgages higher, which in turn will likely support home prices. Cue Claire O'Neill's comment about house prices under Labour. Turning to the specifics of the delayed ABS series, which has been modified to include more seasonal adjustments or perhaps fudges in the numbers, as well as some welcome state granularity. While the total number of new loans in December were down 0.4%, the value of those new loans rose 1.4% across the period. And over the past year, the total of new loan commitments were up a massive 16%, which of course is way above inflation and wages growth. Within that, first-time buyers were only up 5.5%, non-first home buyers were up 16.3%, and investors were up 22.2%. Looking at the detail for owner-occupier loans, they reported that in the December quarter, there were 83,206 new home loans approved. That's a 2.2% rise, or 1,824 more loans compared to the previous quarter. The total value of new home loans approved was $54.8 billion, a rise of 4.2%, up $2.2 billion, and the average loan size rose by $24,777 to $665,978. But in New South Wales, it hit a new high of about $811,000, which is streets ahead of the average. While the number of new home loans rose in the December quarter, New South Wales did partially offset this growth, falling 2.3%, following a fall of 0.4% in the September quarter. Demand for new home loans, excluding refinancing, rose through 2024, despite relatively strong growth in property prices, they said. In original terms, the value of new home loans during the 2024 calendar year reached $205.7 billion, and that was 30.6% higher than the $181 billion value of new loans in 2023. The largest increase in value were in Queensland, up 19.6%, Victoria, up 12.3%, and New South Wales, up 10.6%. The total number of home loans refinanced between lenders in the December quarter was 61,749. That's a rise of 12% compared to the previous quarter, and this follows a rise of 4.9% in the September quarter. New owner-occupied first-time buyers were around 29,964, or $15.97 billion of loans across the quarter, and from our surveys, we know around 60% of those got help from the bank of mum and dad, or better, the family bank. So compared with investor lending and refinancing, first-time buyers are getting squeezed, which perhaps explains the recent government announcement of ignoring HECS. Looking at investor lending, in the December quarter, there were 48,876 new investment loans. That's down 2,293 compared with the previous quarter, but the total value of new investment loans was $32.4 billion, a fall of 2.9%, or down $1 billion. The average loan size, though, rose by $25,065 to $674,316. In New South Wales, the average loan was more than $865,000, well above the national average. The December quarter fall in the value of new investment loans followed a record high of $33.4 billion in the September quarter, which was slightly higher than the COVID-19 peak back in March 2022, the ABS said. Despite the December quarter fall, the value of new investment loans during the 2024 calendar year, in original terms, reached $125.1 billion, and that was 29.8% higher than the $96.4 billion back in 2023. The average size of investment loans increased 7.9% compared to this time last year, despite some moderation in house prices over the second half of 2024. And the strength in investment loans through 2024 was driven by New South Wales up 29.3%, Queensland up 40.9%, Western Australia up 55.9%, and South Australia up 40.7%. Excluding South Australia, Those states saw the strongest falls in the December quarter. And note too that refinancing of existing loans has started to rise following a recent dip, as fixed rates in particular eased back and earlier cheap loans matured. This is true both across external refinancing, which means across banks, and also internal refinancing, i.e. at the same bank, and true across both owner-occupied and investor loans. So we're seeing mortgage debt ballooning to the benefit of the banks. See CBA's recent results. And when interviewed conveniently, the CEO, Matt Common, denied that growth in mortgage lending had any significant impact on house prices. But we, of course, know the strong credit impulse is one of the main drivers of home price growth, supported by greater demand from high migration, tax breaks for investors, many of whom are losing money on a cash flow basis, by the way, and also a lack of appropriate supply. The whole housing issue is now an election battleground, with the coalition opposition promising to allow homebuyers to raid their superannuation savings for a deposit, and it has committed to watering down responsible lending obligations. So both sides have policies which will boost housing demand and increase mortgage debt, driving prices higher. As a result, they would make the affordability situation worse. Remember, the word mortgage comes from the old French phrase, which translates to death pledge. The term refers to the pledge ending or dying when the loan is paid or the property is foreclosed. Given the longer terms of new mortgages and the later age of people getting one, mortgage defined as a death pledge has never been truer. But then, do ordinary Australians who want a home have any choice but to play this game? No. Frankly, because the game is rigged. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.